Hello. Hello everyone. Hope you can hear me. Yep. Okay, what do I see on the chart? Oh, it took. Ah, I'm out. I'm back. And let's see what happened. Hmm. It took this. It went into the inversion. Let's see. My target is this. It is said to be the RTH gap that we have. Usually it may come down, but until Papa Paul speaks, I want this guy to stop speaking. Let's see what's happening on crypto. Oof. Everything is set to pump. Okay. Everything is pumping. Ethereum, everything. I don't trust it. I'm looking at this. So let's move into the 15-minute time frame. Okay, this is set to be liquidity sweep. We got the sweep. Now what do I see? I see this unrated liquidity, sell side. This would be the draw mostly, and this would be my magnet. And here is said to be the 15-minute inefficiency. Let's see what happens at 2:30. When he comes at 2:30, that's when the market really does everything. Until then, we don't have any form of setups or anything. We're just sitting on our hands. There'll be one more pump, maybe. I'm waiting for the time that you need to trade, okay? Time that you need to trade is 02:45 p.m. EST. If you want to trade, if you really want to trade, you need to wait for it. But this is what I see. It should pump back down, and if you see in the 15 minutes over here, this will be considered a good point of entry, or even this should be good. This 15-minute breaker block anticipation. If you want to really constrain it, you can constrain it over here. This is anticipated breaker. If you move into the 5 minutes, I don't see anything as of now. You can see it took the high. If you look at the 4-hour, it took the high, and here is the other thing, other fair value gap. If it takes this, then it might go here, but all-time highs, I think ES has taken the all-time highs. ES has taken the all-time highs. Not looking good. I'm seeing divergences forming. I'm seeing really big divergences forming, and I don't like. It's going to be bearish. It's really going to be bearish. This should be a weekly draw, and this should get run. It's really bearish. As of now, it's really bearish. Yeah, it's really bearish. It's really bearish, man. I really feel this low could be taken instantly, and then these lows, if it really moves, it should go for this and this. These are the first draw and the second draw. That is what I am seeing. It should come over here. This is what I see in the 4 hour. If you take the 1 hour, this is said to be ICT's typical two-legged. This is said to be the first leg, and I really see this dump happening today. Yeah, I really see this dump happening today. He and he is not live yet. He needs to start talking. When he starts talking, this should be rated, and this should be rated. These two. If he, if they keep this intact and then dump it down to here, then it's a divergence on the daily. It's really a divergence that is about to form. Let me see. You don't want to trade this now. The 4 hour inversion is really helping a lot. But we are not trading it. We are not trading this as of now. This is not what I. Please don't trade this until it breaks this structure over here. Until it breaks this, I'm not trading it. He needs to speak. But this is the first leg. Okay. Then comes the second leg. Here I would look into what's happening. I wouldn't trade that much today. Don't try to pass any accounts. That's all I can say. You can also look at the TPO chart if you want to. We have this, and I take this. Let's see what the TPO has. Yep, this is the naked point of control. Okay, I would draw a line over here. This is said to be a naked point of control on the TPO chart. This week it should reach here, this week's terminus. And here is also another naked point of control. Yeah. Other than that, I see this is the range. This is the range that I see. It's between here to here this week. This is the range. If it reaches here, 50%, take it. If it goes again to the, what you can say, finding the ranges up 50%, and it's 50%, it would go up again to the NVOG and again come back down 50%, and then we'll reach down here. This is what I expect to happen. So let's see. So that is the range that I'm looking at. But he will not do it today. He will not do it today. It might go here another time, and then we can dump and enter in over here at the NVOG, and then come back for the sell side, and then this sell side. Anything can happen. If you look at standard deviations, let's look at standard deviations. This is, if it is a market maker sell model. If you see this as a sell model, here's the terminus. Okay, here's the terminus of the sell model, and this is one accumulation, and then it accumulated again over here, and this is the terminus of the buy model, all-time highs. Then we came down, and then we came up, came down, came up, came down, came up. So this is said to be a long-term high, intermediate term high, and let's see if this holds. I want to see this. We can also test the ranges over here. If you test the ranges of this reaction to this reaction, standard deviation projections. Okay, it lines perfect on standard deviation of the range. Yeah, I believe it is going down. I don't see this moving up or something. This is the draw on liquidity. Overall, on liquidity. These are what I'm trying to see. Let me see, what is he doing? He's not doing anything. Still 7 minutes till Papa Power comes out. So what are my expectations? The print is bearish. The first thing, the print is bearish. The first leg is bullish, and the second leg is anticipated to be bearish. So this is what I see. So how do you trade this? Okay, one, rules. Let's speak of rules. Okay, rules. Don't degen into passing the account. Try only micros, not financial advice. No trading is recommended. If you stay on your hands, you'll have the move tomorrow. Wait for him to speak. Wait for him to speak. My analysis is it should go down. How far? Maybe 1, 2, some kind of thing like that. It will go down. One sell side to here we can expect for sure. If you look at the 30-minute, you can see that there are some fair value gaps over here. Event horizon PDA. I think this high is what they are gunning towards. It might happen. I'll mark it as buy side liquidity. Okay. So this high, if it gets protected on the 30-minute time frame, if it does not get violated or something like that, this should be a strong high. This should be a strong high. wouldn't recommend trading this. Did he come? Nope, he did not come. He should be in 2 minutes. Okay, the last one. When he comes, I'm gonna turn off the music. And let's see what he does. Okay. Let's see what Papa Powell is doing. Okay, they're on. He's on. Mr. Powell's going to come soon. Let him come, let him come. He's taking his own time. Let's see what color tie does he wears. If he wears a blue, he's going to pump. I hope. I think he wears a red. Yup. It's starting to dump. It's collecting orders. Here, if you see over here, this will be oh, he's wearing purple. He wants this. Good afternoon. The famous words. Okay.
The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong.
What I would say is,
but inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued,
the questions where
the risks to
the
achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace.
Ooh.
GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment.
Yep. You shut down banks.
Committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs
He needs
per
to
month.
stop talking.
The unemployment rate has edged
He
up
needs
but
to
remains low
stop
at 3.9%.
talking. And he
Strong
stops
job creation
talking.
has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration.
2:45.
Nominal wage growth has been easing and job vacancies have declined.
Here's a
Although
Fair
the
Valley
jobs to
gap.
workers gap has narrowed, labor demand still exceeds the
Let's see
supply
if
of
this
available
holds.
workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation.
It's not
The median
holding.
unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year.
This is
Inflation has eased
significant.
notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and
This is
other
said
data
to be
indicate that total PCE
a minute
prices
breaker.
rose 2.5% over the 12
This is
months
said to
ending
be
in
a breaker
February.
block with the Fair
And
Valley
excluding
gap.
the volatile food and energy categories, core PCE
This
prices
is said to
rose
be a breaker the
2.8%.
gap.
Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2%
This
in
should be a good form of
2026.
resistance. Yeah. I mean,
The
a
Fed's
breaker
monetary policy actions are
block
guided by our mandate
mitigations.
to promote maximum employment and
Should
stable
go up here.
prices for the American
Best
people.
price.
My
After a
colleagues and
minute,
I
we
are
should know.
acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of
This is where
essentials like food, housing, and
I
transportation.
see the entry.
We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that
Let's
if the
see
economy
what it
evolves
does.
broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer.
The breaker held.
We know that reducing policy restraint too soon or too much could result in a reversal of
I
the
think
progress
this may
we've
be
seen
the
on
first
inflation,
leg.
and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks.
Again to the breaker.
The committee does not expect it will be appropriate to reduce the target
If
range
this goes above the
until it has
breaker,
gained
then it's
greater
not
confidence
valid.
that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments
It
of an
could
appropriate
wick
path for the
into
federal
here.
funds rate based on what each
Yes,
participant judges to be the most
that
likely
I would
scenario going
anticipate
forward. If the economy
of
evolves
wicking
as
into
projected,
here.
the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1%
Yeah.
at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan.
I'm
If the
out.
economy does not evolve
I'm
as
out.
projected, the path for policy will adjust
Just
as
one lap,
appropriate
man.
to foster our maximum employment and price stability goals.
It's going up.
Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise.
You can see this
But rather
over
allows
here.
us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a
Holding.
smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our
We shall
securities
wait
holdings,
till 2:45.
consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Okay. Questions?
Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger growth.
Order filled.
That's
What
it.
should we infer from this notion that on average rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Well, it doesn't. No, it doesn't mean that. What it means is that we've seen incoming as I pointed out in my opening remarks. We did mark up our growth forecast, and so have many other forecasters. So
Fair value
the
gap
economy
is holding,
performing well.
encroachment above.
And the inflation data came in a little bit
And it's
higher as a
nothing.
separate matter, and I think that caused people to write up their inflation. But nonetheless, we
This
continue
high
to make
should
good progress
hold.
in bringing inflation down.
Usually
And,
this should hold.
So
When you just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
So we're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that, because that's what will happen over time. But we stress over time, and so I think we're
If
making
this breaks,
projections
I'm
that do
bullish.
show that happening, and we're committed to that outcome, and we will bring it about.
But I see more sell side liquidity over here.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but
Really,
it still
he
hasn't
needs to
shown
start
up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents,
It's
lower
really
market rent
beginning.
increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
In
And
30
will you be
seconds.
able to get overall inflation down to target if housing doesn't break through quickly, and does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this
Liquidation.
year.
Stop filled.
Where housing services
Stops
inflation will
has been
come
filled.
back down as current market
No more
rates are
trading
suggesting will
as
happen,
of now.
and where non-housing services will move back down.
Just on
Some
micros.
combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Nick Timmeros of the Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along
This
the
high
lines of the
needs to be taken.
recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of
You can go
1995?
on it. It's
It's more,
consequent
I would put it more in
encroachment.
the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, you know, if we ease too much or too soon, we could see inflation come back, and if we ease too late, we could do unnecessary harm to employment and you know, people's working lives. And so, you know, we do see the risks as two-sided. So it is consequential. We want to be careful. And fortunately, with the economy growing, with the labor market strong, with inflation coming down, we can approach that question carefully.
Finally, closure
Let the data
above,
speak on that.
but didn't close
That's really what I
above.
was thinking.
How much of that inflation that we've seen so far this year do you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But
Oh,
I would
we
say
got
the
angry.
January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects.
Yep,
there.
the highest
Nonetheless, we don't want to be
taking,
completely
take
dismissive of
it,
The
take
February
10.
number was higher than expectations, but we have it at currently well below 30 basis points core PCE.
Okay, it's going for the buy side liquidity on the upside.
Number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to
There's
anyone's
buy side
confidence
liquidity
that we're moving closer
18,428.
to that point. But you know, we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more.
Just a little bit more.
We wanted to be careful about that decision, and we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and, say, May to be able to get the
Okay,
confidence
it's our
that
time.
you say that, you know, you still need, or by June,
I'll keep it over here.
is there enough data for you?
This is all
to
low
just give us a
resistance
sense of your
liquidity run
thinking there?
over here.
Thank you.
Yeah, so we make decisions meeting
This
by
is all
meeting,
low
and
resistance
we didn't make any
liquidity run.
decisions or about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
But, I mean, just a question of, I mean, is there even enough data for you to be able to?
We'll take,
Sorry.
you know, things can happen during an intermeeting period if you look back, unexpected things. So I wouldn't want to dismiss anything.
Okay,
So
buy side
I
liquidity
just would say
taken.
that the committee wants to see more data that
There's
gives
another
us
fair
higher
value gap.
confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right
Inversion.
now, but if there were a significant weakening in the data, particularly in the labor market,
Ooh,
that could
it's
also
going to
be
the
a reason
TPO value, man.
for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Chris.
Chris Reabert, Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026.
Still now it's bullish.
Can you speak about what might be behind that? Is there a real sense here that the
I don't
economy
like the
has
candle
perhaps
now.
changed in some way, that higher rates
A
will be
wickless
needed in the
candle
future?
is not a topping candle.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question? I don't
buy
think we
side
know
liquidity,
that.
as I said, and it is popping into the Fair Value gap.
During the pre-pandemic, post-global financial crisis era, for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing. Things that don't
Go
move
into
quickly.
30-minute.
I don't think we know. I mean, my instinct would be
I'll
that
reduce my
rates
lot
will not go back down
sizes.
to the very low levels that we saw
Order
where
filled.
all around the world there were long-run rates that were at or below zero. In some cases, I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Yeah.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already at, or you mentioned it being 2.8 in February. I mean, that doesn't sound like much disinflation at all. So are you really,
Let's see how
are you
it
still
does.
confident, or the last press conference you sounded pretty optimistic you would get more confidence to the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth?
I think that higher year-end number reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Well, just are you still optimistic that you'll get the confidence you need this year?
I think if you look at the
I wanna
ICT,
see
what
like
it
this.
says is that
Maybe.
it is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year.
Yeah.
And give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%.
It's again, it's mitigating into the fair value gap. A busy.
Gina Smilik, The New York Times. Thank you for taking our questions.
Okay.
Prior comment to Ian that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut. Would continued strength in the labor market be a reason to hold off on rate cuts? And just in general, if labor supply continued to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
It should be taken.
Yeah. So if what we're getting is a lot of supply and a lot of demand, and that supply is actually feeding demand because workers are getting paid and they're spending, and that's, what you would have is
Order filled.
Kind of what you had last year, which is a bigger economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year, with both with supply chains and also with growth in the size of the labor force.
But so strong hiring in and of itself would not be a reason to hold off on rate cuts?
No, not all by itself, no. I mean, we saw, you saw last year, very strong hiring and inflation coming down quickly. We now have a better sense that a big part of that was supply side healing, particularly with growth in the labor force. So
Order filled.
in and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Neil. Hi, Chair Powell. Neil Irwin with Axios. How do you assess the state of financial conditions right now, and in particular, do you view the kind of easing in financial conditions since the fall as consistent and compatible with what you're trying to achieve on the inflation?
Order filled.
So we think
And scalping.
there are many different financial conditions indicators, and you can kind of see different answers to that question. But
I like this candle.
We do think that
if this displaces below
are weighing on economic activity, and we think you see that in a great place to see it is in the labor market,
this
where you've seen demand
then you
cooling
can
off
see
a little bit
something
from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate, things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. We saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite financial conditions sometimes being tighter, sometimes looser.
Came to the naked point of control. 30-minute fair value gap.
Can you give us more color on
this is a
how
BPR.
the committee is thinking about inflation
Yeah,
dynamics
BPRs.
now? What we've seen at the beginning of the year, are they more one-off increases that will
This is
fade,
said
or
to
is there
be a
more of a
BPR.
secular turn with goods prices rising
Usually
again and
it
service
might not
prices
go
staying
that because
sticky? And
we
also,
are at the
housing prices have been sort of the Godot of
we
this
are at mitigation
cycle. In
levels.
that you keep expecting them to go down, and they don't. How does the committee see this playing out forward since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and you can, and I think many people did.
It's stalling.
See the possibility of seasonal adjustment problems there.
It's
but again,
stalling.
You got to be careful about dismissing the parts of the data that you don't like. So then February wasn't as high, but it was higher. So the question is, what are we going to see? We tend to see a little bit stronger. This is in the data. A little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully.
So yes, is doing.
Feel more
Feel any
confident
divergences?
that inflation is moving down sustainably
Yep.
to 2% when we take that step to begin dialing back our
Oh
policy.
wow!
Now, you've talked about
I like
the
this.
desire to have confidence that inflation is
But
continually
did
moving
not
down. Has the
hold.
recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's
It's going to
confidence,
the
but-
BPR.
confidence. But I would say that the story is really essentially the same.
Now I
And
need
that
to
is
see this
of
placement.
inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see.
The candle,
We've got
I
9
like it.
months of 2.5% inflation now.
I like this
We've had 2
candle.
months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately, prematurely.
Stop talking.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from, the Federal Reserve, first independent body, understanding Congress.
A market structure shift. Finally, a market structure shift.
In the White House that said, calling on you to lower interest rates, to cut interest
Now I
rates
need to
because
see
it
a
says,
fair
quote,
value
"The
gap.
potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from these projects." So has higher interest rates caused that?
Well, first of all, I respect in our system of government, it is Congress that has oversight responsibility.
Next
over the
30
Fed.
seconds.
We place a tremendous amount of importance on our engagements with Congress and always treat them with great
I
respect.
don't feel
In this case, I would say
This is
those are,
not
our
well.
mandate is for maximum employment and price stability, and
Not
the other things
well.
that we do. and that's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation.
Yes.
That's how we can best serve the public and leave the other issues, which in many cases
no
are
fair value
important,
gaps,
such as those you mentioned, leave those to the people who have responsibility for those.
There was another letter from 2 dozen lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
Okay, that is fair value gap.
With respect, and
Order
we write careful
filled.
responses and address concerns. We listen, again, because we're talking to the people who in our system of government have oversight over our activity. So that's, but at the end of the day, we take that on board, but we have to make our judgments and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks.
Order filled.
Work on the payment system, the things that we do.
Thank you. Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question. As chair of the FOMC, would you want to see unanimity on the committee or something close to it, meaning no more than 1%?
Yep.
Order filled.
This is going down.
before you begin cutting
Okay,
rates?
this is going down.
We're very consensus-oriented
Yep.
organization, and we do try to achieve consensus and ideally
Yep,
unanimity.
this is going down.
Dissent, it's something that happens.
This is
Life
the
goes
fair
on.
value gap. This is the high
It's not a problem.
EPO.
We've always had
Now it's
dissents.
coming down. My
But-
first
and so
profits would be here,
you
here.
respect thoughtful dissents very much.
I would
it's
see
like
this.
You may not agree with
Usually
some
this will
arguments,
not.
but you really want to understand
This
them.
will not.
So you may read a book that
This
takes
is
a
not
position that
the
that you
real
have
thing.
long
The
opposed
next is this.
just to understand that book. So I
Okay.
treat dissents with real
This
respect as
is
well.
sell side liquidity. Another sell side liquidity.
Simon Urbanovich with The
Yeah.
Economist. Can you hear me?
Yes.
Okay, great. Obviously, inflation is some ways away from target.
Inversion.
Unemployment, though, if you look at the projection for the full year, 4.0%. In February, we were already at 3.9%.
It's
so
power
quite
hour.
close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth, that in fact there may be some cracks appearing in the employment market? You talked about a significant deterioration in the labor market being a condition for easing rates. What would constitute that in your books? Thank you.
So we, of course, monitor it's one of our two goal variables. We all monitor the labor market very, very carefully, and I don't see those cracks today. And we follow all the possible stories that are out there about.
It doesn't
the
stop.
The overall picture really is strong labor market. The extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved. You're seeing high job growth. You're seeing big increases in supply. You're seeing strong wage growth, but wage growth is gradually moderating down to more sustainable
I need
levels.
to see a break
in
below
many
this.
respects,
Really a good break.
the things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings and quits, and surveys of workers and businesses are always interesting on this. How tight is how easy is it to find a job? How easy it is to find a worker? Those surveys have both
If
come
it
down.
takes the high,
So
that's
the
it.
labor market's in
I might
good
be
shape.
early.
You do see things like the low hiring rate. People have made the argument that if
It goes to the high.
layoffs were to increase, that would mean that the net
Ooh, nice.
fairly quick increases in unemployment. So that's
Held.
something we're watching, but we're not seeing it. Of course, initial
Nicely
claims
to
are
held.
very, very low, and if anything, have tracked
Now
down.
I like that candle.
Watching it carefully, don't see it.
I want this to
And
support
when I
price.
say,
Come on,
something,
dump it.
I use the term unexpected weakening in the labor market. So, we do expect the unemployment rate to.
It should dump now.
The forecast is that it would move up, I think, closer to what we see as the longer run sustainable
Dump
level.
it.
That's just people's forecast, individual forecasts. But
See here,
we're talking about
there's
something
no
that's
body
unexpected.
closure
That's
about
really
this
the point.
fair value gap. It's again going to the fair value gap.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that
that the committee felt it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, is when you say fairly soon, does that mean that the committee would meet about this again in May and a decision could be reached that soon? And I was wondering if you could also just describe the
Let's see
scope
if
of what
it has
the
a body
committee is
close.
discussing here. You're at $95
It's
billion
in.
of caps right now. Would that be
It's
cut
inside
about
the
in
fair
half
value
or
gap.
something in that nature?
That is the final mitigation that I want to see.
So that is what we're discussing essentially is and we're not discussing all the many other balance sheet issues. We will discuss those in due course, but what we're really looking at is
no fair value gap.
slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in treasuries, and we're talking about going to a lower pace.
Yes,
I don't want to give you a
it's
specific
strong.
number because we haven't made
No fair value gap.
an agreement or a decision, but that's the idea.
I'm majorly looking
that's
at
what we're looking at. In terms of the timing, I said
Dixie.
fairly soon. I wouldn't
Boom.
want to try to be more
Dead.
specific than that, but you get the idea.
Yes.
The idea is, and this is in our
There's
longer run
this
plans,
fair
that
value gap,
we may
but
actually be able to
it
get to
cannot
a
be
lower
taken
level
into
because
it.
we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system, and there can be
Now I
times when
see
in the
fair value
aggregate,
gaps.
reserves are ample or even abundant,
Yes.
but not in every part. And
Yes,
those
it's coming
parts where
down.
they're not ample, there can be stress. And that can
YM,
cause you to
yeah,
prematurely
YM is
stop
also
the
coming
process to
down.
avoid the stress. And
The
then it would be
weaker
very
is
hard to
Nasdaq.
restart, we think. So
Yeah.
as something like that happened
Nasdaq is
in
weaker.
19, perhaps. So that's what we're doing. We're looking at what would be a good time and what would be a good structure. And, fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all treasuries balance sheet at some
Chop
point?
City.
So that our longer run goal is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the
He needs
composition
to stop
and the maturity
talking, man.
and revisit those issues. But it's
He needs
not
to
urgent
stop
right
talking.
now. We want to get
Again, mitigation.
this
Oh, it's
decision
going
made first,
higher.
and then we can, when the
It's
time
going
is right,
higher.
come back to the other issues.
Yes. Yes, went higher. Yes,
Hi, Victoria
liquidated.
Guido with Politico. Also on the balance sheet, can you talk a little bit about how the outlook for the banking sector might
Yes, went
impact your
higher.
balance sheet plans? Do you worry that as deposits
Again,
start
it
to
went
shrink, that
higher.
we could see more turbulence?
We'll be watching carefully, but one of the
Let's
reasons
see
we're slowing down,
what
we
yes
will
does.
soon enough,
YM.
fairly soon, I should say.
YM also
slow
went
down,
higher.
is that we want to avoid any kind
Yes.
of
Q.
of turbulence. I wasn't thinking particularly about banking sector turbulence, but
Ooh.
we had some indicators.
Stopped.
The last time, this is our second time in doing this, and I think we're going to be paying a lot of
Okay.
attention to
Very
the
good.
things that started to happen and that foreshadowed what eventually happened.
It's going to the
at
BPR.
the end of that tightening cycle where we wound up in a short reserve situation, and we don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where secured rates are relative to the administered rates, those sorts of things. We will always be watching the banking system for similar signs, though.
Well, is it also because you're not sure exactly how the reserve supply will react once the overnight reverse repo facility
You're
drops
not
near
sure.
at zero?
I think we broadly
Okay,
think
BPR.
that once the
That's the
overnight
final
repo
thing.
Stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that. That's what we think.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask also about the balance sheet. Will you said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point, and will you be setting up the process for deciding that sooner?
Yes,
or
can be
will you wait
traded.
until we're close to the end?
So
This candle is
it's sort of
good,
ironic
actually.
that by going slower you can get farther.
Yes, can be
That's the
traded.
idea. The idea is that with a smoother transition, you'll run much less risk of kind of liquidity problems, which can grow into shocks and which can cause you to stop the process prematurely. So that's where, in terms of how it ends, we're going to be monitoring carefully money market conditions and asking ourselves what they're telling us about reserves. Are they, right now we would characterize them as abundant, and what we're aiming for is ample, and which is a little bit less than abundant, right? So there isn't there's not a dollar amount or a percent of GDP or anything like that where we think we have a
I'm looking for
really pretty clear
divergences, but
understanding of
it's
that.
not
We're going to be
happening.
looking at what these what's happening in money markets, in particular a bunch of different indicators, including the ones I mentioned, to tell us when we're getting close. Then, though, you reach a point ultimately where you stop allowing the balance sheet to run off, but then from that point there's another period in which non-reserve liabilities grow organically, like currency, and that also shrinks the reserves at a very slow pace. So you have a slower pace of runoff, which we'll have fairly soon. Then you have another time where you effectively hold the balance sheet constant and allow non-reserve liabilities to expand, and then that ultimately brings you ideally in for, brings it into a nice easy landing at a level that is above what we think the lowest possible ample number would be. We're not trying for that. We want to have a cushion, a buffer, because we know that demand for reserves can be very volatile, and we don't want to again find ourselves in a situation where there aren't reserves. We have to turn around and buy assets and put reserves back in the banking system the way we did in 2019-20.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you said you're waiting to become more confident that inflation is getting to your 2% goal before you cut rates. Can you just sum up more specifically what data you're looking at that would give you that confidence?
Sure. So most importantly, we're looking at the incoming inflation data and the contents of it and what they're telling us. So that'll be, and also the various components. So obviously that's what we want. We want more confidence that inflation is coming down sustainably toward 2%. And I mean, of course, we'll also be looking at all the other things that are happening in the economy. We'll look at the totality of the data, including everything essentially, as we make that assessment. But the most important thing will be the inflation data that's coming in.
Are there things that you would give more weight to, like wages?
Wages is one thing. We don't. Our target is not wages. It's really inflation. But we would look to the fact that wages are still coming in very strong, but they've been wage increases. That is to say, wage increases have been quite strong, but they're gradually coming down to levels that are more sustainable over time, and that's what we want. We don't think that the inflation was not originally caused, I don't think, mostly by wages. That wasn't really the story. But we do think that to get inflation back down to 2% sustainably, we'd like to see, continuing gradual movement of wage increases at still high levels, but back down to levels that are more sustainable over time.
I don't really see a market structure shift. No.
Thank you. Greg Robb from MarketWatch. Chair Powell, could you say at this meeting whether there were more officials who wanted to be careful and go slower about rates than were at the last meeting? Was there that sense of maybe it's smart to wait?
Okay.
Thanks.
I guess I'll put it this way. If you look at the incoming inflation data that we've had for January and February, I think very broadly that suggests that we were right to wait until we're more confident. So I think I didn't hear anyone dismissing it as not information that we should look at or anything like that. So I think generally speaking, it does go in the direction of saying, yes, it's appropriate for us to be careful as we approach this question.
Brendan. Thanks, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask you about central bank digital currency stuff. We've been hearing a lot from Republicans in Congress about what the Fed is or isn't doing in a digital dollar, but folks,
Volume
you have
imbalance.
said to Congress that you are going to wait for approval before the Fed does anything, launches anything. But folks like House Majority Whip Tom Emmer have said that the Fed is either actively researching or hiring personnel to study the implications of a CBDC. Can you give us any clarity on what the Fed is doing right now on
Oh
a
my
digital dollar?
God, they're not stopping.
So I think we've been pretty transparent on this, but I'll try harder. So we are not getting ready to, we haven't proposed, we haven't come to a conclusion that we should propose or anything like that, that Congress consider legislation to authorize a digital dollar. And it would take legislation by Congress signed by the president to give us the ability to do what we think of as a CBDC.
Finally, come on, no, finally.
So we're just a long
it
way
dropped.
from it. What we are doing, and I think what every major central bank is doing, is we're trying to stay in the frontiers of what's going on in digital finance. And it has many, many different
I want to see a fair value gap.
It has applications in wholesale finance, in the payment system.
You can also use the inversion.
To serve the public, these issues have become very front burner in
Inversion.
the last 5 or 6 years. We need to be knowledgeable about all that. So we actually do have people trying to understand things that are, but it's wrong to say that we're working on a CBDC and then we've secretly got a lab here where we've got one and we're just going to spring it on Congress at the right moment. We don't. I haven't at all, in my own mind, made a decision that I think this is something the U.S. should be doing. I just think it's something we need to understand, and we do have people who are keeping up with that as part of the broader payments landscape. That's how I would characterize it.
Mark. Okay.
Thank you. It's Mark Hamrick with Bankrate. Mr. Chairman, April 27th will mark the 13th anniversary since a Fed chairman began holding regular news conferences. How important is that higher transparency been in your view, both for the proper functioning of the central bank and also in accomplishing your mission? And is there more that you and your colleagues can do
tap
on
into
the
the fair value
transparency
gap.
front, and what might that look
Yeah.
I generally think
like
this
that.
movement actually started, 30 years ago, when some academics posited that a more transparent central bank, if the public understands your reaction function, the markets will do your work for you. They'll react to the data.
I want this fair
so
value
it
gap
all
to be
happens that way.
maintained.
So there's been a march
I
toward greater
don't
and greater
want to
transparency.
see.
And that certainly Chairman Bernanke advanced that. So Chairman Greenspan did. Chair Yellen did. And so we went from four press conferences a year to 8. So now every meeting really is live now. I think that's a good innovation. I wouldn't want to turn it back. We also have done a bunch of other things. We have an annual supervision report, financial stability report. There's a long list of things that we've done.
Order filled.
Nothing comes to mind as really desperately in need of doing at this moment. We're very transparent. We have no shortage of FOMC participants speaking to the public through the media. And so that channel is full, I would say.
Okay.
I think it's generally broadly helped and made things better.
Order
not
submitted.
Every day and in every way.
Well, to follow up, has there ever been a day where you wanted to put that genie back in the bottle somewhat?
Of course not.
Order filled.
Oh, good.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Not to harp too much more on confidence and inflation, but you did say earlier in this press conference that the recent inflation data hasn't raised anyone's confidence. But when you testified before the Senate a couple weeks ago, you told lawmakers that you are, quote, not far from receiving the confidence needed on inflation to
I got it
cut
wrong
rates.
today.
So are you still of that belief or not? What are we to take by those words, not far?
So let me say my main message at that in those 2 days of hearings was really that the committee needs to see more evidence to build our confidence that inflation is moving down sustainably toward our 2% goal. And we don't expect that it will be appropriate to begin to reduce rates until we're more confident that that is the case. I said that any number of times, so those were kind of the main part of the message. We repeated that today in our statement.
I really
also,
don't
to the language
believe
you
this
mentioned,
went
I really pointed
normal.
out that we had made significant progress over the past year, and what we're looking for now is confirmation that that progress will continue. We had a series of inflation readings over the second half of last year that were really much lower. We didn't overreact, as I mentioned.
Order
that's
filled.
what I had in mind.
But given that you said that PCE for February 2.8%, the estimate, and that we have been seeing PCE, core PCE, coming down by 10% every month, I mean, wouldn't you be at about 2.4% this summer, June, July, to a point where you could cut then?
Well, we'll just have to see how the data come in. We would, of course, love to get great inflation data. We got really good inflation data in the second part of last year. Again, we didn't overreact to it. We said we needed to see more, and we said it would be bumpy. And now we have January and February, which I've talked about a couple of times. So, we're looking for more good data. We'll certainly welcome it. Thank you.
Ah, he stopped. He finally stopped. Thank God. Bye. Whew. He finally stopped. I should have waited till he stopped. It's rising. Yes is rising and Q is rising. And yeah. Nothing to be made of it. Yep, nothing to be made of it. Let's see how it goes. It's a higher point of fair value gap. Okay, liquidity taken.
Order filled.
I'm having an unlocked. Only one. Buy stop
Order
limit.
submitted.
That's it. If it wants to take, let it take.
Order submitted.
Yep. Love it. Really love it. Really love the drop. I really want to see the push down. Yeah. Push. I really want to see. Okay, it's the BPR. It should support price. Okay. And voila. It should support price. Let's see. The BPR should act as support and price. Yeah. Thank God I played with only the micros. If I play the minis, that's it. Boom. I need to see inversion. This should be inverted. Yeah. Inversion. Nice. 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 Okay. Inversion fair value gap. The first PDRA. Oof. Nice. Tap. Consequent encroachment. It might go and take the high once. Again. This formed a PDRA. Here. Yes. But there is still no displacement. Sorry, market structure shift. I need to see market structure shift on the ES. YM. Now market structure shift. Only NQ is the weaker. I would really consider this as a form of wolf wave. I would consider this form of an wolf wave 3 drives pattern. It can go high over here. Let's see. Liquidity taken. I don't want this candle body to close above this. 20 seconds. Yep. 8, 7, 6, 5, 4, 3, 2, 1. Boom. I don't want to see another candle above. Okay. Oh my. I think the stream went down.